about technological change and new kinds of instruments, cryptocurrencies. How do you see the potential for more favorable regulations coming on them, and potential risks from that for the system?
So we went through a wave of failures and fraud and things like that were the headlines for a couple of years. And I think what you see now is, and during that period, by the way, we worked with Congress to try to get a legal framework for stable coins, which would have been a nice place to start. We were not successful. I think that the climate is changing, and you're moving into sort of more mainstreaming of that whole sector. So Congress is again looking at both the Senate and the House are looking at a legal framework for stable coins. Depending on what's in it, that's a good idea. We need that. There isn't one now. And stable coins are a digital product that could actually have fairly wide appeal and should contain consumer protections of the typical sorts and transparency. And that's what the Senate and the House are working on. So that's a positive thing. I also think some of the, we took a pretty conservative, and other bank regulators took an even more conservative perspective on the guidance and rules we imposed on banks. I think there'll be some loosening of that, and I think we'll try to do it in a way that preserves safety and soundness, but that permits and fosters appropriate innovation, but that does so in a way that again doesn't put consumers at risk in ways they don't understand or make banks less safe and sound.
Who is the buyer of gold right now, and what money is buying gold?
Foreign central banks. Listen, you're going to see, this is a prediction. I don't know if it's true. I know we're going to have a Brics currency at one point in the next 24 months. I bet you part of it's backed by gold, the digital version. You're seeing foreign central banks buy gold. Listen, when I first got into the markets in the late 80s, I was always fascinated with the fact that in developed markets like the US or Japan, there was no real correlation between the shape of the yield curve and fiscal policy, right? You could spend a lot, you could run big budget deficits, and the yield curve didn't care. But if you're an emerging market or developing market, it cared a lot. And so this shift between, we just call it the Minsky moment, when does people start caring? The way the US market is behaving in a risk off is exactly opposite of what we've seen for 30 years, right? It's interest rates higher and the dollar weaker. That means we're starting to behave more like an emerging market than a developed market. Now, I'm not saying we've gotten there yet. It's the early stages, and that should get us all nervous. I'm sure that's got Secretary Bessent nervous. I'm sure it's got, people around the White House who understand this nervous.
Mike, some people tried to dismiss these moves last week and say, look, we don't want to make too much of a 2 or 3 day thing. Look, the bond market's already calmed down. So you do think that what was happening was maybe the beginning of a bigger shift that DC needs to pay attention to?
I think it. I'm sorry,
what about I was just going to say, kind of leading from that, the parachute out is, well, they might be working on a whole new kind of global financial architecture. And I'm curious if you have any thoughts on that too.
Yeah, listen, the architecture we had brought peace and prosperity to the world in over 80 years, more so than we ever saw. And so globalization was great for the world. It was great for wealthy people in the West. It was great for Vietnamese workers. It was really not great for the factory worker in the US and in Europe. And we're trying to pivot that. It's a very noble, it's funny, my politics kind of align. I would have thought if I was in charge, I'd want to bring down the deficit and I'd want to work on inequality. And this is what the goals here are. I just think you can't do that by wishing we didn't have this kind of trade system, wishing we didn't have 30 years of supply chains built out. People make decisions. If you're a Colombian coffee farmer or an American furniture importer, retail furniture person, based on some medium-term horizon. And we're literally ripping up that horizon overnight.
Are we stuck, Mike? I mean, do you think the market is basically saying to the administration, okay, you want to try this goal, the electorate has kind of given you this mandate to some extent, you went to put it into practice, and it just screamed no. And is that because the fiscal deficit is too big? If they had been able to really make a meaningful change on that front, would it all have worked? Or do you think this is just the global market saying this can never work?
I think the global markets are saying you're going too fast, and this strategy is not going to work. That's what I think the markets are saying. Listen, just the increase in our interest rates since this thing started is a higher annual cost than all the Doge savings, right? You just think we have 35 trillion in debt, and you go 50 basis points or 30 basis points, even that's 150 billion dollars. It's really hard to take this deficit down, and doing it at the time when you're going to put growth at risk and shift the entire tax code, right? Tariffs pre this tariff move accounted for about 2% of taxes, where income taxes and payroll taxes are 85%. And so we're going to cut taxes here and raise them here. The numbers don't add up. And that kind of uncertainty, I think, has just scared markets.
Tools you brought in to deal with the zero lower bound was quantitative easing. But you've also used quantitative easing to fix disruptions in the financial markets. Are you going to be more specific about what your objective is with quantitative easing as you go through this review?
So in the beginning, it's typically we're using it for financial market function. That was the case with the global financial crisis and with the pandemic. And we did try to explain ourselves through the pandemic, and our explanations did change. But I think it's fair to say we might have done a better job of being clear about why we were doing it. And that's something that we're aware of and looking at.
No discussion is complete without talking about AI.
Yeah.
With AI coming fast and furious, it could affect productivity. It could affect employment. There are some people who say we will see for the first time technological unemployment in a serious way with AI. What are your thoughts about it, and how will it impact the Fed going forward?
So, like everyone who's been exposed to what it's capable of, it's beyond. I started thinking about it as like a better version of Google, but it's not. It's like a better version of a person. It can do amazing things, and so the question is, all through the 250 years of technological innovation, technology evolves, and people worry that it's going to replace human labor and people will be unemployed, and that hasn't been the case. It may be the case in the short run, but in the long run, what it's done is raise human productivity and therefore living standards. So, is this going to be the case where it eliminates more jobs than it creates? And we just don't know. You come back in 20 years, will it be the case that just people are much more productive in their work because of AI? Or will it be the case that AI has just replaced a lot of people? And I think it's very hard to say, but it truly is remarkable in what it's capable of. And it's, we had a demonstration by a Wharton professor recently, and you speak to it like it's a person. And it kind of responds like a person, and the things that it can do are really amazing. By the way, this is early days. They're talking about even the next couple of years will bring more dramatic breakthroughs. So I think it's one of the 2 or 3 things most likely to bring dramatic change to the economy all around the world in the next 20 years. And I'd say very hard to say how it shakes out. Many of them are CEOs of significant companies, and they. This uncertainty that they're feeling and the issue with imported components to their products is just a huge issue. But with if you look back at the pandemic, if you remember, there was a shortage of semiconductors, and that led to a shortage of cars at a time of extremely high car demand. And it was a prolonged shortage because production couldn't keep up. And that led to one of the things that led to an extended period of inflation. So when you think about supply disruptions, that is the kind of thing that can take time to resolve, and it can lead what would have been a one-time inflation shock to be extended, perhaps more persistent, and we would worry about that. In this case, you can look at the car companies, which their supply chains are likely seem to be on track to be disrupted significantly, and you would worry that process will take some years, and that the inflationary process might be extended. So these are all of this is highly uncertain. We're thinking now, really before the tariffs have their effects, as how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are, and then we can make a better assessment of what the economic effects will be.
When there's been a global shortage of dollars?
Sure, absolutely we do. Just for everyone's knowledge, we have standing dollar swap lines with 5 large central banks, and they go to the jurisdictions where there are big overseas dollar funding markets. And in effect, those are overseas markets where, for example, a European or Asian institution is buying an asset-backed security that is backed by loans to American consumers. So in effect, these are loans to American consumers, and we support that. We want to make sure that dollars are available. They need dollar funding to hold those dollar assets. So the way it works is, when needed, we lend to the central bank in dollars, and they pay us back in dollars. They then pay in their currency. They lend on in dollars, and so we take no credit risk or anything like that. And it supports dollar funding markets. Dollar funding markets are very sensitive during times of crisis, and it's very helpful. The reason we do it is it's really good for U.S. Consumers. So we'll continue to do that, just as part of the dollar being a reserve currency, the reserve currency, most important, and we will do that. Is well capitalized with liquidity and is quite resilient right now to the kinds of shocks that it may face. I do believe that. In terms of the commercial real estate, there are, and this has been the case, we've been working on this for 4 or 5 years now. There are some banks, it's mostly medium and small sized banks, who have elevated concentrations of commercial real estate, some of it troubled, and we've been working to make sure that those banks have a plan, have capital, and can absorb the losses that they're doing. So, and that's been going on for some time. The very largest banks don't tend to have high concentrations, so this is a problem that we have known would take years to work through, but we're really well into the process of working through it. In terms of the non-bank financial sector, it's grown enormously. The provision of credit by non-banks has grown just really fast. Most of it has been funded, though, with a private equity-like structure where it's limited partners who are signed up for 10 years to a general partner to invest that money. They're not depositors who can run. Your money's committed, and so that funding model is kind of run-proof. That isn't some law of nature, though. So when you do start to see shorter-term funding creeping in, to your point, though, Raghu, this very fast-growing and now quite large private credit part of the economy has not really been through a significant credit event or significant. It's really grown since the pandemic, and so just for that reason and for how fast it's growing, we have a close eye on it. It doesn't have the same kind of prudential regulation, though, that the banking system has. So we're watching it carefully, and as I mentioned, it's a more stable funding source to the extent its institutional investors signed up for a long period. But we're watching carefully. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again, it's the markets processing historically unique developments, and with great uncertainty. And I think you'll probably see continued volatility. But I wouldn't try to be definitive about exactly what's causing that. I would just say markets are orderly and they're functioning kind of as you would expect them to in this time of high uncertainty.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And make sure you're joining the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And also, guys, make sure you go like and follow the TikTok. More videos to come. And we have the Fizz Jerome in the house 7 years later. We know the power of 7 at the Economic Club of Chicago. And we have Jerome Powell asked about stable coins. And what did he say? Stable coins are needed. And we know why. These stable coins are programmable. Being able to tell you what, when, and how to buy. And you have 3 to 6 months to spend them, or poof, they're gone. Stable coins are nothing but digital dollars on steroids. And remember, the Crypto Teacher told you, And we have Mike Novogratz on a Brics currency. First, he says it's a prediction. Then he says, I know that the Brics is going to have a currency, and some of it is going to be backed by gold. And who told you that first? That's right, the Cryptoteacher. And guys, you're hearing it from the horse's mouth now, because we are close from this happening. We know how close we are. And the sheep stay asleep on things that don't matter. And by the time they wake up, these robots, algorithms, and drones will be taking over this economy. And remember, the Cryptoteacher told you. And he said that we are resembling the emerging markets. Remember, they want to devalue the dollar and take us to a level playing field. And he talks about the new global financial system that's being built. And we know that's that digital economy. You have two financial systems running side by side, and the sheep have no clue. It's unbelievable. You can't make this stuff up. Everything's going to be tokenized and put on blockchain and running without a human involved. And we had Jerome Powell speak about the power of this AI technology. Says it is amazing and only is going to get smarter. And remember, Jerome Powell is the one who basically told us during the C word what was about to happen. That's why I constantly play that clip. And then he's asked about the global shortage of dollars. Guys, we know these countries are trying to get off the dollar. They're not even worried about the dollar anymore. They're working in their own currency or their own stable coin. And remember, the Cryptoteacher told you. And then he's asked about tariffs and the jobs market. And of course, what did he say? He needs more clarity because we know the Fed is always late. And then he says he wants to go through with Basel III. And we know that's the capital requirements for these big banks. But what is it going to do? Destroy these small and medium-sized banks. With real-time liquidity, these banks are not going to survive because the fees are being cut. You pay all these fees to banks due to trust. Now with blockchain, you no longer have to worry about that. You know the money is there. So a lot of these fees get cut out. And remember, the Cryptoteacher told you. And Mike Novogratz says there's so much chaos in the market, the average investor is scared. And a lot of that comes from the mainstream media. Because we know during the bull run, Bitcoin hitting its highs, that's when the media makes Bitcoin and crypto a topic. And of course, they come in and buy the top. And then the market pulls back. And because they don't know the agenda, they never come back and invest again. We've seen this movie before. And remember, the Cryptoteacher told you. And Fed Jerome Powell is only there to react. He's going to watch this economy crumble and then come in at the last minute. And again, we've seen this movie before. Remember, it's problem, reaction, solution. Their job is to run in with a solution they had ready 20 years ago. And that's to bring in these robots, algorithms, and drones that take the economy over, and the sheep go inside the metaverse. And remember, the Cryptoteacher told you, because he knows when it comes to the NWO, it's all planned out. You have a wonderful day.
What I can say is, of course, the people being laid off in government, this is highly significant to them. We don't know how big that's going to be. Right now, it's not big enough to affect a workforce of 170 million people materially. In terms of the cutbacks in funding and for science and things like that, we do see in areas, particularly in cities that have a lot of universities and research hospitals and research institutions, we're really hearing significant layoffs and significant impacts on employment. I don't know how much that will total up to. And of course, in addition, cutting back on scientific research may have implications for economic growth, for productivity, for health, for all kinds of things. But those are very difficult to estimate in real time.
Now, given that we're talking about the future, you may be confronted in the not so distant future with both higher levels of unemployment as well as potentially higher inflation. And of course, the policies that each one requires could be different. You talked a little bit at the podium about how the Fed would see these two and how it would address it. Just giving you a chance again to elaborate on that.
Right. So most of the time, when the economy is weak, inflation is low, and unemployment is high, and both of those call for lower interest rates to support activity, and vice versa. So most of the time, the two goals are not in tension, and they're not really in tension now. The labor market is still strong, but the shock that we're experiencing, the impulses we're feeling, are for higher unemployment and higher inflation, and our tool only does one of those two things at the same time. So it's a difficult place for central banks, to be in terms of what to do. And so the best we can do is we actually have a little provision in our consensus statement, which is the thing that we vote on to embody how we approach these questions. What we say is we will look at how far the economy is from each of those two goals, and then we'll ask, might there be different paces at which they would approach those goals? We'll look at those things and think about them, and we'll no doubt be a very difficult judgment. Again, we're not experiencing that now, but we could well be in that situation, as I mentioned in my remarks. My view is that we should proceed to complete the Basel III Accord, and we would have to do that, and would look forward to doing that in conjunction with the FDIC and the OCC. But our view is, and I think the bank's view as well, is we should complete that. You need international minimum standards. That's kind of a common good, and we're not bound by them. Nothing. The United States has plenty of input into what those accords contain. So our view is strongly that we should complete those, and we could do it, I think, relatively quickly. We're not so very far away from what would be a good, I think, outcome. First of all, thank you for being here today. It's a pleasure to be here with you. Actually, the appearance I did here was my very first appearance as chair 7.5 years ago. So it's great to be back. And I would agree with you that it's been an eventful 7 years. Putting it mildly, I keep waiting for the 3 months of calm, that never comes. But to your question, I guess to set the stage, let's look back at 2024. 2024 was a year where the economy grew 2.4%. Unemployment remained in the low fours, close to mainstream estimates of maximum employment, and inflation came down and was running at the end of the year around 2.5%. That's the economy that we had, and I won't decide how to characterize that, but that's where things were. Where we are now, again to your question, is the administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood. And my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance of this year, and then, or at least not making any progress, and then we'll resume that progress as we can. First, I'll briefly discuss the outlook for the economy and monetary policy. So, at the Fed, we are always focused on the dual mandate goals that Congress has given us: maximum employment and stable prices. Despite heightened uncertainty and downside risks, the U.S. economy is still in a solid position. The labor market is at or near maximum employment. Inflation has come down a great deal, but is still running a bit above our 2% objective. Turning briefly to the incoming data, we'll get the initial reading on first quarter GDP in a couple of weeks. The data we have in hand so far suggests that growth has slowed in the first quarter of this year from last year's solid pace. Despite strong motor vehicle sales, overall consumer spending appears to have grown modestly. In addition, strong imports during the first quarter, reflecting attempts by businesses to get ahead of potential tariffs, are expected to weigh on GDP growth. Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. outside forecasts for the full year are coming down, and for the most part point to continued slowing but still positive growth. We are closely tracking incoming data as households and businesses continue to digest these developments. In the labor market, during the first 3 months of this year, non-farm payrolls grew by an average of 150,000 jobs per month. While job growth has slowed relative to last year, the combination of low layoffs and lower labor force growth has kept the unemployment rate in a low and stable range. Meanwhile, the ratio of job openings to unemployed job seekers has remained just above 1, near its pre-pandemic level. Wage growth has continued to moderate while still outpacing inflation. Overall, the labor market appears to be in solid condition and broadly in balance, and is not a significant source of inflationary pressure. As for our price stability mandate, inflation has significantly eased from its pandemic highs of mid-2022 without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. Progress on inflation continues at a gradual pace, and recent readings remain above our 2% objective. Estimates based on the most recent data from last week show that total headline PCE prices rose 2.3% over the 12 months ending in March, and that excluding the volatile food and energy categories, core prices rose 2.6%. Looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy, and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored, and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. We will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to our discussion.
This tariff thing came out of nowhere for a lot of people, and it has provided a really big shock to the global economy, right? And that's kind of happening at the same time where we're really reimagining what our security apparatus is going to be, right? So you had 80 years, really, post-World War II, of a similar security apparatus for the world and an economic structure. And then in 89, you really accelerated that with globalism, right, with the global revolution. And Trump saying, wait a minute, I want to change that. And so that uncertainty is showing up in all markets, right? And, the broad U.S. stock market is roughly down 10% on the year. That doesn't seem near enough dislocation when you put it in context that we're looking at this titanic shift in what we're doing. And so I think people are in a risk-off mindset. Bitcoin broadly does well with these kind of macro conditions, unless there's this kind of risk off. And what I mean by that is there's always two vectors in Bitcoin. One is the macro story, which you're seeing play out in gold, right? Which is the uncertainty, get myself out of the dollar, get myself into something safe. But the other is the adoption story. And because we're such a young asset, the adoption story needs more calm. It just does. And so when there's this kind of chaos, the new buyers disappear. And that's what we've broadly seen. We've seen very few new buyers. And so we see people sell, they get short, they buy back. It's starting to trade better in the last few weeks relative to stocks. But broadly, Bitcoin has been the Mag 8 and not gold. I don't think that's a permanent condition. And listen, gold's telling you everything you need to know, right? I used to say this all the time. Bitcoin and gold are report cards on financial stewardship, right? If you're the Secretary of Treasury of the U.S. or any country, your report card really is what's gold, what's the yield curve telling you, and gold is something that's not great.
So if he's not worried about the employment side, there can't be stagflation. If he's not worried about saving the market, then who knows where inflation is going right now. If he's talking about tariffs, how can you talk about tariffs without knowing what the after effect is? He's only there to react to the after effect, not the pre-tariff. Would you agree with that?
I mean, yeah, I thought it was clear, yes, the Fed is going to wait to see the impact on the economy. I thought that there was an acknowledgement of stagflation when he said that they could be in the challenging position of finding that the goals of the dual mandate would be in tension. So in other words, employment and labor, and that there is going to be inflation because of the tariffs. And so therefore you put those two together, and those seem to be the ingredients.
Then unemployment, then jobs will drop. But if you had to pick between the two out of those mandates, I would say he's got to save jobs versus attack inflation. That's my opinion.
Well, it seems like he's saying that he's got to get a hold of price stability in order to address weakness in the labor market. I don't know. That was my interpretation.
Well, it's 12 months ago, I think it was 12 months ago, that he said in response to a question, this is Jerome Powell, I see neither the stag nor the inflation, and that's coming back to bite him in the you-know-what, because that's what we're in the midst of right now. And if you start to see an uptick in the unemployment rate, which I think in this environment it's almost inevitable, then you have stagflation right in front of you, and regardless of what they do, it's going to be the wrong thing. So they're better off just sitting on their hands.
Going to a different